Welcome back, and in this video we are going to go over break-even points and different forms of leverage on Excel. So we have some information here that was given. I guess I can make it look a little better. All right, this is a business that sells pies. So the information we have is that there's an estimated pie sales in units of 4,500 pies. The price they sell it each is $17. The variable cost per pie or per unit, it's $11. And what we can do is at this point, we can calculate the contribution margin per pie or per unit by taking the sales price minus the variable cost, and we have a contribution margin per unit of $6. Let's say the company has a 25% tax rate, a total fixed cost of $25,000. So we can now calculate the fixed cost per unit per pie. So we take the total fixed costs divided by the estimated pie sales in units. And that gives us the fixed cost per pie. Let's say the company has debt of $50,000, an interest rate of 7%, and a sales growth of 5%. We're not going to be using sales growth in this example because we're not going to do a projection. But it is information given. Sometimes they give us information that we don't need for the exercise. So let's start building an income statement. It is a simplified version of an income statement, but it will have what we need to go on with our analysis. So total sales equal, to start the formula, is going to be the total amount of pies times the amount we sell each pie. So we're looking at $76,500 in sales. For variable costs, we do the same. We take the total pies multiplied by the variable cost. So what's our total contribution margin? We take our sales minus our total variable cost, and that is our total contribution margin. Just for quick practice, this number could have been achieved by taking the contribution margin per pie and multiply it by the total pie sold, and you get the same 27,000. So total fixed costs. In this case, we're doing total fixed costs, so we're just going to equal it to the same 25,000 we have there. So what is our EBIT, or earnings before interest and taxes, also known as operating income? We can take our total contribution margin minus our total fixed costs, and that is our EBIT for this scenario. Interest expense, we can take the total debt we have here times the interest rate, and that is going to be our interest expense. So now we can go down to earnings before taxes, also known as taxable income. So we take our EBIT minus our interest expense, and we have a loss there of $1,500. Now we still, even though there is a loss, we still calculate the taxes because you can use that tax credit forward or backwards, but that's for another class. So we take the taxable income and we're still going to multiply by the tax rate. And that gives us the tax. In this case, you're looking at a tax credit of $375. For net income, we still have to do that part where we take the earnings before taxes minus the tax. And you still have to do the minus sign, even though it's going to be a negative on a negative, because your net income will not be as bad because now you can count with that tax credit. Anyways, so here we are with our income statement. So now when I wrote, well, Let me start by knowing the lowest my sales can go in units before this one starts becoming negative, because this is an important number, operating income. So I want to know my break even of operating profit. So that means when EBIT equals 0. So how do we calculate that? Now there's two numbers we can get. How many pies I have to sell based on that price. And then we can say, well, what does my total sales need to look like? So this number doesn't go negative. It stays a 0 or positive. So let's see how we are going to do that. So the thing to do is you take your total fixed costs, you can grab from here or from here, and you divide it by the contribution margin of each pie. That means we have to sell about 4,167 pies to make sure we don't go in the negative. Now, you can't sell, well, I guess you could sell half a pie, but let's just say they can only sell total pies. What would that look like in dollars? If we take that unit break even and multiply by the sales price, it means that our sales have to be at least 70,833 and some change to make sure this number doesn't go below 0. So let's see what that looks like. If I put this number here, you should see the formulas kick in. So I'm going to go 4166, and I'm going to put a bunch of sixes. As you can see, that's a 0 there. Now it's red and in parentheses is because since this is a rounded number, it's still kind of some kind of fraction of a penny in the negative. But this is also why we say that you should always go, when you're doing break even, you should always go up to the next unit when you cannot sell a piece of it. So the right thing to do is make sure that you sell 4,167. Now that's $2 there. That's not 0. But what happens if you go down to 4,166? You're actually negative $4. So that's why you should always go to the next unit if you cannot sell half. Now, if you want to go very precise, I guess I can go 4,166 and just add 2/3, which is the same. And look how we get an actual 0 there, a specific 0. Now that's being rounded up. If I give it a couple of decimals, you see how it starts showing the effect. So if you could sell 2/3 of a pie, then that's exactly where you will break. All right, let's go back to the original number so we can continue. All right, so now we know that that's the minimum amount of pies I should sell. So this number, operating profit, does not go in the negative. And this is the same value, but in dollars instead of units. Okay, so now let's say I want that to be a minimum of $20,000. I would like to know how many pies I have to sell for this number to be $20,000. I want to target an operating profit of $20,000. That's what we're saying. So you do the same thing here, but instead of 0, you just add that $20,000. So what we can do is we start the formula and open the parentheses. Give me 1 second so I can do this right. We're going to open the parentheses, right? And we're going to do the same formula. We're just going to add that. So I'm going to take my fixed cost plus my requirement of the $20,000, then divide that by the contribution margin per pie, per unit. So I will have to sell 7,500 pies if I want this number, my operating profit, to be $20,000. Let's see how that works out. 7,500 at $17 each. And there it is, $20,000 showing on the operating profit. Okay, now let's say I want net income, which is important, profit. your actual profit at the end of the day, when everything is said and done, after interest and taxes and all this stuff. Let's say that I want to know how many pies I got to sell to at least this be zero, so I don't lose money. I don't make money, but I'm not losing money either. In this case, you were losing money. So how do we do that? Well, the logical way to approach it is, I want this to be zero. That means that the taxable income has to be zero, because then you pay zero taxes. So in other words, these three numbers, this will be zero, for this to be zero, for this to be zero. So really it's kind of saying like, well, I need that earnings before taxes to be zero. So what you do is then you check your expenses above it. So there's an interest expense and there's a total fixed cost after your contribution margin. So a way to net income is look at all your fixed costs, the interest fixed costs, which interest is a form of fixed cost of financial leverage. So, and that's what you're doing. You're looking at all your fixed costs associated, and then to see how many pies you're going to sell. So it's going to be similar to these formulas, except that I'm looking for this number. So I'm going to go with the interest expense. I'm going to work my way up just so it makes some kind of sense. And the fixed costs. And then you divide that by your contribution per pie, and it will be $4,750. Let's see if that checks out. $4,750. And there you have it, net income zero. Not $4,750, 4,750 pies. You will sell that many pies at $17. This will be your total sales, and that would get you, you don't make money, but you don't lose money. That's your net income, break even. Now, let's do something different. Let's say, well, instead of selling more pies, can I increase my price per pie? Can I increase my price per pie in order to make more money without having to sell more pies? Now, this is assuming that if you increase the price, you can still sell the same amount of pies, which that's a different topic in economics about price and supply and demand. So let's assume that you can still sell 4,500 pies. And instead of, this one was telling you sell more pies so you can break even. Now we say like, well, how about they sell the same amount of pies, but for a higher price? What price would that be? So we're going to kind of follow the same formula here. We're going to follow the same formula here, but we're going to then include the variable cost for this to make sense. Okay, so let's go ahead and do the interest expense, well, parenthesis first, plus the fixed cost like we did before. We're still going to divide it by the contribution margin per pie. I'm sorry, we're going to divide it by the amount of pies we're going to sell, 4,500. Because remember, we don't want to change that. We're going to sell the same amount of pies. And then we're going to add the variable cost per pie. So again, we're going to take the fixed costs and add them together. And in parentheses, so that first happens. Then we divide it by the amount of pies that we're going to sell, because we're going to say we're not going to change that amount. And then going to add the variable cost per pie, and that will tell me the price per pie. And that is our $17.33. So what it's telling us that if I change the price to $17.33, and really this is, again, I got to increase a little bit because there's a bunch of threes. So if I change the price to $17.33, bunch of threes, we get to net income of 0. Again, it's doing that negative because it's a fraction of a penny somewhere in there. So if I was to then manipulate this a little bit and go equals 17 plus 1/3, then it gives me exact 0. But again, if you do 1733, you're going to be in the negative. So that's not going to work because you cannot charge fractions of a penny. So you always have to go one up when there's a fraction, because while your net income is not 0, it's not negative. So you know you have to charge at least 1734 to not go in the negative. 1733 pushing the negative, 17 and $0.33 puts exactly at 0 net income. Okay, so let's go back to the original point. And now let's talk about degree of operating leverage, degree of financial leverage, and degree of combined leverage. Okay, so these are pretty straightforward. You take your total contribution margin and you divide it by your EBIT, or your operating income. And that's what how you get the operating leverage. So you take your total contribution margin and you're going to divide it by your EBIT, your operating income. Because this is reflecting, these two numbers, the difference reflects your fixed cost. Remember, that's where your operating leverage is, the machinery, that building. In this case, we have a 13.5 operating leverage. Remember, the higher the number, the higher the risk the company is considered. Now, is that risk or not? You would have to compare it to other companies in the same industry to see if that's considered normal, high, or not. It also depends if this is an early company. Now, what happens too is as your sales change, let's say you start selling more pies, like 8,000 pies, notice how it just dropped because now you're having more operating income for the same amount of fixed cost. So you don't have to reduce your fixed cost. You can increase your sales and improve your operating leverage that way. But that's what we spoke in the PowerPoint slides, where higher volumes lower your risk when you have high fixed cost. Let's go back to the normal number we have. Now, the degree of financial leverage, what do we do there? So for the degree of financial leverage, we're going to use operating income, and we're going to divide it by the taxable income. And this is why. So we take the operating income and we divide it by the EBT, taxable income, earnings before taxes. Because what's in between those two numbers is your interest expense. So that's the fixed cost associated with financial leverage. Now, in this case, we get a negative because we have a negative here. So when you see a negative on either one of these, by the way, that's bad. When you see a 1, it means you don't have leverage. When there's a 1, there's no degree of leverage really, because then they're the same numbers divided by the same number. So anything above a 1, it starts increasing your risk, but with potential of higher profits. Anything below a 1, it's bad. It's typically bad. As in you're losing money somewhere. Now, the degree of combined leverage, all you do is multiply these two. Now, again, being a negative is bad. In this case, when you look at both, the negative is coming from financial leverage, so that's something you have to address there if you want to go at positive. But on the same note, this one could be high, could be low, who knows? Now, something to be aware of, that this numbers between 0 and 1. That's why I said anything below 1 could be bad. And the reason is, let's say that our total fixed cost was $30,000 instead of 25. And there you have it. So we still get a negative, but the negative now move up here. Your degree of financial leverage is below 1. It's still bad because but the thing is, because you have two negatives, it's becoming positive, but it's below 1. So that's a bad thing. That's how you can see that it's a bad thing, even if it's not negative, that actual result. But that's how we calculate degrees of operating leverage, degrees of financial leverage, and so on and so forth. Now we have those. Let's take a quick look at what would happen if we do go up to the 7,500 units. Notice how now our combined leverage is 2.73, and we improved both leverages and we have profitability. So you can also target a number here and then adjust these as you need it. But for now, we're just going to experiment with different numbers, and that's how it works. So 5,000 pies do improve your situation, but at least you're in the positives. Okay, but 4,500, definitely something to work on, whether price or units per pie. Okay, so we will stop this portion of the discussion in Excel. There will be another Excel video where we talk about some of the functions in Excel to do the same thing here, which is called Goal Seek and Solver.